And of course, you know, anytime you're throwing extra money at this loan, it's going to improve the overall scenario. But again, you know, this is why I have this channel. This is why I'm reacting to this video for you guys. I want you to hear that, yes, on the surface, this is an absolutely fantastic idea and really a no-brainer. But, you know, for some folks out there, this is not going to be a good move for them. All right, and welcome in to another episode of CFP Reacts, where your certified financial planner, Scott Schiller here, your host, reacts to the best and worst financial planning advice in social media. And I'm so glad that you joined me today. In today's video, I'm going to be breaking down a very, very common topic that comes up a lot in my conversations regarding mortgages, right? And so lots of us have mortgages. Some of us have many mortgages. And so if we want to own a home, unless we're going to pay cash for it, then we're going to need to get a loan for the remainder of the house. So we'll have what's called a down payment. And then anything that's left over is going to be something we'll need to borrow from a bank via what's called a mortgage, okay? And so in today's video, we're gonna be reacting to a video from George Kamel, where he does a really great job here of breaking down what to consider with your mortgage, right? And so this is gonna be a great video for you if you already have one, or if you're considering buying a house and setting up a mortgage here in the near future. You'll get a lot out of this. And so the idea here is that there's a lot of great planning points with it, okay? And so lots of things to consider. And so let's jump right into it.
Recommend that will be the same amount you pay every month for the life of the loan. What a lot of people don't realize is that most of their payment for the first few years is mostly interest. It's not actually knocking down the principal at all. And here's why. The interest is based on the full loan amount. So while the balance is high, the interest will stay high. But as you pay down the loan, more of your payment will go to principal and less to interest. This is called amortization. And the bank's not just doing this.
Okay, so this is true, and amortization is this big fancy word. It's an accounting term, and what it essentially means is that if we buy, let's say as an example, a 30-year mortgage, well, the first few years that we're making payments, majority of our payment is going to interest, okay? And what interest is that in order for a bank or an institution to be willing to loan us money, then they're gonna need to receive some sort of return back from that. And that is what interest is, okay? And so what amortization does is that as we get further and further along into our mortgage, a larger and larger percentage of our payment goes to the actual principal of our loan. In other words, it goes into the value of our house. And what that really is an investment in real estate. It's an investment into the home that you live in, which is a real estate investment.
Just doing this out of the kindness of their heart. They're getting a pretty sweet deal here because thanks to interest, banks bring in an estimated $640 billion annually from residential mortgages alone. And that's allowed the banks to do a lot of great philanthropic things that benefit the world, like buying the naming rights for skyscrapers, major stadiums, and arenas. So that's how.
Yeah, and love that. And you know, big banks, you know, when you see a big bank or any big financial services institution advertising on TV, what you should be thinking is who's paying for that? Who's paying for that? And it's gonna be the clients, the customers, okay? And it's part of the reason why I didn't, in my own practice, I didn't join a big name firm, is because I know that the clients are not the focus. And so anyway, I have a lot of pride in being independent and with a firm that believes in the client and not spending money on Super Bowl commercials, or stadium rights and things like that. And so, you know, and also just note on the $640 billion in interest that banks receive on an annual basis, that's money, they're not stealing that from people or doing anything that's wrong. Remember, they're loaning money out, right? So they're helping us get that house.
Mortgages work, and when they're pulling in nearly $750 billion while you're paying interest out the wazoo, I think it's safe to say that feels like a scam.
Yes. That's exactly what it is.
But wouldn't it be great if you could keep more of your...
It's not a scam. It's not a scam. There are things that are real scams. Somebody buying a mortgage and paying interest on that loan is not a scam. I'm sorry.
Instead of helping a bank slap their name on yet another big functionalist postmodern skyscraper? Well, turns out there are mortgage options that help you keep more of your money and, like I said, save potentially hundreds of thousands of dollars in interest. But even still, people are choosing the route that costs them more and makes banks rich. So let's crunch the numbers so you can see the difference for yourself and just how much you can save on your mortgage. Let's say you get a
Okay, this is really interesting. All right, so pay attention to this. This is pretty cool. I think he does a great job of breaking this down.
$300,000 mortgage, which is pretty in line with the average US mortgage of $330,000. And let's start by looking at the mortgage most people get, the conventional 30-year fixed rate mortgage. And we'll assume an interest rate of 7%. I'm gonna punch all this in.
So I personally have a 30-year mortgage. Does that mean you should? We're gonna get to it later in the video. It depends, not necessarily, okay? So just because I have a 30-year fixed rate mortgage does not mean that everybody should have that.
Send to the mortgage payoff calculator at ramseysolutions.com. I'll drop a link in the description so you can check it out for yourself. So our loan amount is $300,000. Date of first payment, let's say it was the first of the year. Loan length, 30 years, interest rate 7%. You can see here, it's gonna give me the principal and interest, $1,995.91. But how much interest are we paying over those 30 years? Let's find out. Oh boy. So you can see here, it says new total interest, $418,000.
Yeah. And I know that seems like a huge number and he's making it nice and dramatic for us here. But just remember, that's over 30 years, okay? It's over 30 years. It's not like you're paying that in a lump sum or anything like that. And so there's what's called an opportunity cost that's gonna come into play here, which means you can invest that money over time in something else.
And here's why you're paying a metric butt ton of interest. For this $300,000 mortgage, you'd have a payment of about $2,000 a month. And remember amortization, where you pay more interest up front? Well, that means that in the first year, out of that $2,000 monthly payment, less than $250 went to actually paying down the house, went to the principal. The other $1,750 is all interest, baby, making the lenders more rich. That's almost 90% of your payment.
It's not making the lenders more rich. Remember, you borrowed the money, you own the house, you have the house, okay? And so, there's of course that benefit to it, okay?
That's building the bank's wealth instead of your wealth. In fact, it would take you 20 years before you even have $1,000 of that payment.
And by the way, I'm not a guy who's gonna defend big banks a whole lot, okay? So, but I pride myself on being transparent and clearly being honest. In this case, banks aren't doing anything nefarious or anything like that here. There's lots of other examples where that is the case, and we've seen that many times.
Going toward the principal balance. That's insane. I mean, think about this. $420,000 in interest. That's a whole other house. The original loan amount was only $300,000. So you're paying over double in interest. And I don't know about you, but if I'm paying for 2 Crunchwrap Supremes, I expect to get 2 Crunchwrap Supremes. Or is it Crunchwraps Supreme, like AirPods Pro? Either way, paying more in interest than the original amount of the loan is
Crunchwrap Supremes, I like those.
Is asinine. Yeah, I just went full Shapiro. I'm not scared.
I make racks off compound interest, y'all live with your parents.
All right, so surely there's a better option than that 30-year mortgage disaster, right? Well, enter the 15-year mortgage. It's like the 30 years cooler, more fiscally responsible cousin. And we're gonna use the same example here. $300,000 mortgage, 7% interest rate, but this time with a 15-year term. And bonus side note for you, I'm being generous here because the 15-year loan almost always comes with a lower interest rate than the 30, which would save you even more money. But for apples to apples, we'll keep it all Honeycrisp, okay? All right, so I'm gonna go back, edit the original loan to 15 years, and you'll notice my payment goes up to about $2,700. But let's see how much interest I end up paying. $185,000.
And this is expected, right? The quicker you pay off the loan, so 15-year versus 30, you're paying it off in half the time. And so we're gonna pay a whole lot less interest in that, in doing it that way. Same thing if we were to do a 5-year mortgage or a 2-year mortgage, right? And so the shorter the time frame, the less overall interest that we're gonna pay. Now, but keep in mind that we're talking about a long period of time in 30 years versus 15.
Pretty wild, remember.
And so I think this is interesting. I would say probably in most cases, a lot of cases, we're gonna wanna go, or at least highly consider that 15-year loan, okay? However, keep in mind that there's an opportunity cost. We can invest in other things. And then also very important that we need to manage our what's called take-home pay percentage, right? So we only want, hopefully somewhere in the neighborhood of 20 to 40% of our take-home pay going to our housing costs, okay? And so housing costs, that's gonna include mortgage, that's gonna include maintenance, that's gonna include insurance, it's gonna include everything that it costs to run your home, your take-home pay from work. We really want to keep that in as low a percentage as possible, of course, but somewhere in the 20 to 30% range is highly recommended. And so once we get so high, then we become what's called house poor, okay? And what house poor means is that so much of our take-home pay is going into our house that we end up just simply being a prisoner to it. And we're not able to save in any other way. And keep in mind, when we're buying down our house, we're making a real estate investment, okay? And so what we also don't want is too much of our portfolio into real estate. Now, I'm a big fan of real estate. I think real estate is great. I think residential real estate, certainly in certain markets. I live in Austin, Texas. Lots of markets in Texas and other areas of the country are very stable and have wonderful, really great long-term outlooks to them. And so we certainly want to have a percentage of our overall portfolio, our overall money mix into real estate, but we don't want it all there, okay? We don't want it all there. Why, right? So why is that, Scott? If real estate has been proven to be such a stable and good investment over time, why am I worried about having too much in there? Well, I'll give you an example, because sometimes it's not always the best, right? And a recent example is what's gone on here in Austin, Texas. Well, we've had really a flat real estate market the last 4 or 5 years, right? And so, and part of the reason for that is there was just so much growth leading up to it that we've really stabilized here in the last 3 or 4 years, let's just say. And let's just look at the last 2 years as an example. So our real estate values haven't really changed a whole lot. They've maybe gone up just a little bit, right? However, the S&P 500 index, which is the broad-based investment in stocks, owning the corporations that are creating all this growth and inflation around us, has grown at over 20% each of the last 2 years, right? And so we don't want to miss out on that either, okay? And so that's just something that we need to consider as we're breaking this down into what is going to be best for us.
Think of it this way. You're paying a little more now, but you're saving a lot more later. So knowing all that, why do people still choose a 30-year? Well, here's what they tell me as they call into the Ramsey Show. Well, George, I like having that wiggle room with a 30-year with a little smaller payment. Or, I can't afford the payment on a 15-year. Well, listen, the truth is that affording a 15-year mortgage takes time and discipline. And if you're fiddling around with consumer debt...
This is a great conversation to have with your certified financial planner. Obviously, of course, shameless plug, I'd love that to be me. If it's not me, I highly recommend all of you, everybody out there, to please obtain and get a good certified financial planner in your corner. And this is a great question to ask them. Hey, should I do a 15-year or a 30-year mortgage, and why? And allow them to break it down for you and crunch the numbers and show you which one is going to be best for you. Okay, and so I do this all the time for my clients, and what it is it comes down to lots of different considerations. What else can we invest in? What is our current overall mix of investments now? What type of house are we talking about? Are we talking about a second home? Are we talking about our primary home, a vacation house, something we're renting out? All of these things come into play when we're making that decision.
Like $700 on a car loan, credit cards, you still have student loans sitting around, then yeah, it's going to be impossible to afford a 15-year mortgage. But if you focus, get that debt out of your life, all of a sudden you have more room in your budget. And you may need to look at a less expensive house or wait a little bit longer to save up a bigger down payment in order to afford a 15-year mortgage. But wouldn't that be worth saving hundreds of thousands of dollars?
Duh.
Well, in just a second, I'm going to show you what an extra payment or two could do to save you even more in interest.
Okay, this is pretty cool. But again, keep in mind, this isn't going to be right for everybody. Because again, we can use these dollars for other things. Okay, so just keep this in mind.
And a whole lot of time. And as you know, time is money. So if you're looking to save time and protect yourself online, check out Delete Me. They're a sponsor of today's episode, and they do the tedious work for you by finding and removing your personal data from dirty, no-good data broker sites that sell your info for a profit. Gross. What does that mean for you? It means less robocalls, less spam texts, saving you money on that mortgage. Let's say you've already made the brilliant decision to go with a 15-year mortgage. Chef's kiss.
Again, not always a brilliant decision. Possibly, maybe we could make the case that it's probably, but please, not always the case. Not always the case. It depends on your situation.
And let's say once a year, you throw in the pot an extra mortgage payment of $2,700. Just that one little extra payment once a year that you could probably afford by canceling the Peloton subscription you haven't used since 2022. What does that do for you? First, you save about 25 grand in interest over the life of the loan. Second, you shave off a whole year and 10 months from the payoff time. That means you'll own your home outright in just 13 years and 1 month. Guaranteed. This isn't just an extra payment. Think about this. It's giving you time and money back in your pocket because of those interest savings.
Yeah, so again, on the surface, I think this is awesome. I think this is awesome, of course. As a financial advisor, of course, this is fantastic. If we can have extra savings, extra money at the end of the year to punch in an extra mortgage payment every year, that is a fantastic idea for most of us. But keep in mind, we can use that money for something else. You might be thinking, well, what do you mean, Scott? What else would I want to use it for? Well, I don't know. Let's look at where you are, right? So if you have a 401k or a retirement plan at work, well, maybe we put the money into that, okay? And we can use pre-tax money that's going to go to work for you right away and achieve even a higher rate of return over a 15 or 20 or 30 year period of time. And so that would then be better for you, okay? And so, another question I get all the time is, okay, well then how are you gonna break that down for me, Scott? Now, how is this done from a financial planning standpoint? And the way it's done is that I need to be doing what's called a cash flow projection for my clients, right, for you. So I'm projecting out, here's where we are today, where are we gonna be in 20 or 30 years? And we're looking at all types of different returns, good returns, bad returns, all the above, and that will allow us to make good decisions now for the long term. And I can basically break down the difference between, okay, Scott, show me the difference between doing a 30-year and a 15-year, and break that down for me, and show me what that's going to do for my overall cash flow planning. And cash flow is just a fancy term for your money growing. And where it's gonna be in the future.
In your future. Okay, let's get even crazier. What if you could swing that extra payment every quarter? You throw in an extra payment of $2,700 every 3 months, that's 4 extra payments a year. And what's the payoff? Well, first, you save a whopping $72,000 in interest over the life of the loan. That's enough to see Wicked over 250 times on Broadway. Second, you cut 5 years and 4 months off.
And of course, anytime you're throwing extra money at this loan, it's going to improve the overall scenario. But again, this is why I have this channel. This is why I'm reacting to this video for you guys. I want you to hear that, yes, on the surface, this is an absolutely fantastic idea and really a no-brainer. But for some folks out there, this is not going to be a good move for them. Okay, it's just not, because there's other things that we can use and there's other things going on that we need to consider to make this decision correct. And so this is a great one to throw at your certified financial planner. Hey, show me why I should consider this and break this down for me. This is a great one to have the professional do for you.
Payoff time. That means you own your home outright in under 10 years. Now, if you started this plan at age 30, that means you'd be mortgage free by 40. And then, well, that's extra cash to
being mortgage or debt free at age 40 is absolutely fantastic. I mean, that is an absolute great path to wealth independence. I'm a big fan of that for sure.
To invest, travel, or finally buy that backyard pizza oven you've been dreaming about. Just think of the dinner parties. So the bottom line here, you work too freaking hard to stay broke and give all of your money to banks for the next 30 years. And that's why I make videos like this. I want to see you win. I want to see you have that.
I want to see you win too, right? And so anyway, I really appreciate you guys tuning in. If you've stuck with me this long, I really appreciate you hanging in, and please like and subscribe to my channel, like this video, and to schedule a one-on-one call with me, please visit my website, schillerwealth.com, and you can set up your no-cost, no-obligation discovery call. Let's have a conversation, and that way we can get to know each other and see if I can be of help to you, and help you guide through a decision like this one, which is the 15-year versus the 30-year. Which one do I do and why? Most importantly, why? And so thank you so much for tuning in, and I will see you in the next video.